All right, this is Mr. Ray, your favorite options trading teacher. And so today we're not going to be talking theoreticals anymore. We're going to get down to a real trade that I've made. No simulations, no textbook examples. This is a live trade that I made in my RA account using the wheel strategy on a stock known as CrowdStrike. It's the ticker CRWD. And so from December 2025 to May 2026, that's 5 months. I had 198,000 deployed, 22 rounds of cover calls, and I'm going to give you the honest truth about what happened, okay? Including where the wheel beat the market and where I probably left some money on the table. And I'm sharing this with you because I want you to see the wheel, how it actually works. Not just the wins, but the real math, the real lessons, and the real decisions that have to be made. By the end of this presentation, you're going to understand exactly how to run this strategy and when it's working and what to watch out for. So look at the headline numbers. $3,600 profit, right? 420 was the price that it was assigned. CRWD later recovered to actually 579. It gapped up pretty good, and that gap tells the whole story. And we're going to break that down together. So let this screen register with you. Look at the point of each metric, the capital that was deployed, the number of shares, the cover call rounds, and then the net profit and loss. All right, so first of all, we got to answer the question, why is CRWD good for the wheel? Okay, let me tell you. Before I sell any put, I ask three questions. Number one, is it a quality company? Number two, does it have liquid options? And number three, does it pay me enough premium to make it worth my time? Once it settles and answers all three of those questions, only then will I move forward. And so CrowdStrike actually checks every box, right? It has 29,000 enterprise clients. 60% of the Fortune 500 companies are running on their platform. This isn't a mean stock, people. This is a company that is protecting the net worths of banks, government, and hospitals. So when the stocks dip, the business is still intact. And so I'm comfortable owning these shares pretty much at any price. And then look at the IV, the implied volatility. It's the key metric. Crowd runs about 40 to 60% IV consistently. And that inflated premium is what we collect as income. Low volatility stocks like Walmart might only give you $50 on a put, but Crowd will give you 500 to 1,000 on that same trade. Same strategy, 10 to 30% times the income. And here's the rule. I want you to burn this into your brain. Only will stocks you'll be proud to hold at any price. If the stock drops to zero, no premium saves you. Quality first, premium second, always. All right, so this is where the wheel starts. We start selling cash secured puts. That's phase one, right? And so my mindset going in is either I'm going to collect the premium and walk away free, or I'm going to get a great stock at a discount if I get a sign. Either way, it's a win before I make a single trade. So here's what happened. I ran three separate wheels on CRWD simultaneously. I had one wheel at 200 shares, 510 strike price. I collected 760. I ran another wheel at 100 shares, $495 strike price. I collected 450. And then I ran the final one at 100 shares, $465 strike price. I collected 362. All three got assigned in December because it pulled back in January. And so when it pulled back hard. And so I got assigned. And so now here's where most students get scared. They feel like an assignment is a loss. No, it's not. An assignment means just phase two is just about ready to begin. That's planned. You planned on it. You wanted this outcome. Now notice how I spread across three wheels at three different strikes. That was intentional by me. Cost averaging through cash secured put itself. Not all at one price. That's discipline and that matters, right? Because stocks are volatile. And so I had a total invested 198,000. I got $2,500 in premiums, and now I own 400 shares of one of the best cyber companies out there on the planet, and I've already paid to own them. All right, here we go. the covered call grind. Now, I've already been assigned these stocks. I have 400 shares. This is where most retailers would fold. Remember, the stock had dropped. Most people would panic, hold their shares, and hope that the shares would come back. Well, hope is not a strategy, baby. Wheel traders, on the other hand, we do the opposite. We sell covered calls every single week. Now, look what happened over the 5 months. I had 11 rounds of covered calls on that one wheel alone, wheel four. Look at these numbers: 2,500, 1,900, 2,500, 1,100. That's all income I collected while the stock was in the red. Where anybody else that owned this stock during that time, they were staring at a paper loss. I was still getting paid. Look at that: 2,700 gross premiums across all three wheels. And that's not even included when I was assigned the stock, when I was collecting premiums on the cash secured put. That's just the covered calls. On the 198,000 position, I was earning 14% over 5 months in a down market. Come on, somebody. Now watch what happens to the cost basis. It started off at an average of 495. After all those premiums I collected, it was down to 411 per share. I didn't buy more shares. The premium did the work. Now here's a warning. I got to give it to you right now, and we'll see how it plays out on slide 6. I was selling calls at 420, 440, 460, and my cost basis was 495. That means I was selling below my cost basis. That was the one mistake I made in this trade. When CRWD recovered to 579, I didn't get to take advantage of the difference between the 495 and 579. I had already agreed to sell at 420. Now we're going to come back to that. Okay, that's just a point of clarification. All right, let's look at the math now across all of those assignments. So CRWD trades around 420. All my covered calls are going to expire in the money. The buyer exercises. Now my 400 shares get called away at 420, right? Because it's trading above 420. And so the position is going to close. My shares get called away. Here's the full math. So on my first wheel that I had of 200 shares at 510, got called away at 420. So the stock loss was 18,000. I collected 16,000 in premiums, net minus $1,100. Tiny loss on the position when the stock actually fell 17%. Look at wheel number 5, 100 shares at 495, got called away at 420. Stock loss 7,500. Premiums was 8,400, net positive. The premiums overcame the stock loss entirely. And then the last wheel, 100 shares at 465, got called away at 420, stock loss 4,500. The premiums were 8,400, net positive 3,920. So on a total of 198,000 that I had deployed, 168,000 came back from the assignment, 33,000 in premiums across all the phases. The net result is that I made $3,600. That's positive on a stock that fell from 510 to 420. That's the wheel working exactly as it was designed. Most investors holding this stock were down $30,000, right? The wheel printed profit during that time. CRWD didn't stay at 420, and that's what comes next. All right, here's the crux of the matter, and there's the whole reason why I wanted to show you this case study, because I wanted to compare using the wheel strategy versus a buy and hold individual. Okay, so here's where I got to be completely honest with you. This is the real lesson in this case study, and I'm not going to sugarcoat it. I'm not going. I show you this for a reason. Now look at the buy and hold column. A person who would have bought 400 shares of CRWD at 495 at an average cost, and if they just would have held it through the dip, through the volatility over the 5 months, through everything, they would be sitting on CRWD today at 579, and their position would be worth $231,000. They would have had an unrealized positive gain of $33,000. Zero covered cost sold, zero income strategy, just hold it and wait. But look at my wheel result: 3,600,000. The gap between the two outcomes, $29,000 in the favor of the buy and hold. Now, I need you to understand why that gap exists because it's not a flaw in the will strategy. It's a result of one specific reason. And this is the mistake I don't want you to make. I sold covered calls below my cost basis. Okay? My cost basis was 495. I was selling them at 420, 440, 460. I was agreeing to sell my shares below the cost that I paid for them. So when the crowd recovered all the way to 579, 84 share price move upward, those shares were already gone at 420. I locked in the stop loss permanently and forfeited every dollar of that recovery. So here's the golden rule. I need you to get this. This is the whole reason for the lesson. Never sell covered calls below your cost basis, okay? If your cost basis is 495 and your lowest strike price is 495 or higher, then don't do it. If you can't find a premium that you like above your cost basis, then just wait. You don't need to sell, just hold it and let the stock recover. The will is a premium collecting strategy. It's not a stock replacement strategy. When you break the golden rule, you're putting a ceiling on your upside. You remove yourself from any stock recovery, and this trade proves it. So, does it mean that I lost? No. It delivered some income in a down market, and I closed the position when most investors would have been in the red. But there is an honest gap here, and I'm showing it to you because this is what good financial education looks like, the whole truth and nothing but the truth, baby. All right, let's end this thing on 4 lessons I want you to take away from here, okay? Lesson one, the will is an income engine, it's not a prediction machine. Income is the product. And we didn't need CRWD to go up. We just needed for it to stay still or move slowly. The premium is the win. The stock generated 33,000 in premium income while the stock fell 17%. That was the engine running. Lesson two, assignment's not failure, baby. It's phase two. Reframe that in your mind right now. Assignment means that you executed correctly. You own a quality company at a lower than market price with the premium already in your pocket. Now you sell cars. That was the plan from day one. Lesson three, only will stocks that you're proud to own, baby, non-negotiable, ironclad. If CRWD had collapsed to 200 and it stayed there, no premiums would have saved me, baby, because it's not if it dropped that far, that means it wasn't a quality company. The quality of the underlying stock is the foundation of the entire strategy. If you wouldn't buy the stock outright, then don't sell a put on it, baby. And then lastly, patience and consistency beat timing. 22 covered calls over 5 months, no market predictions, not trying to call the bottom, just showing up, selling the next call, premium after premium after premium. The system does work. All right. And so your assignment for the next session is I'm going to show you how to go to Thinkorswim and we're going to do a paper money account. And then we're going to find one stock on your watch list that you'd be proud to own. We're going to run the wheel, baby. We're going to check the IV. We're going to check the earnings calendar. We're going to check the 52-week range. And all I want you to do is just identify a stock at this time. We're going to walk through an actual trade next time together. All right? All right. Don't forget to follow me on all of my social media platforms, baby. Keep up with the latest, greatest, and what we're doing. Mr. Ray's Wealth Academy, baby. All right, this presentation is only for educational purposes, baby. This is not sound financial advice. I'm just a man out here trying to share with you education.